Hi guys, welcome back to our channel. Real estate tokenization sells a simple story. Buy a token, own a slice of an income-producing property, get automated rent distributions, all frictionless, global, and transparent. In practice, that neat narrative collides with messy local realities. Broken toilets, unpaid taxes, code violations, court orders, insurance shocks, and empty secondary markets. When we strip away the marketing, what remains is a structural mismatch between digital ownership and physical accountability, and that gap is where most investor losses begin. Below we explain, with evidence, why this gap is real, how it shows up in tokenized real estate projects, and what investors must insist on before they hand over capital. 1. The marketing versus maintenance paradox. Token platforms advertise fractional ownership and passive income, but tokens don't fix leaky roofs or collect property taxes. Local property managers and municipal systems do. Where management is weak, tokens can continue to circulate while the physical asset decays. A tokenized claim on a damaged house is still a claim on a damaged house. We have already seen this dynamic in public investigations. A major tokenized property operator with hundreds of Detroit homes is now subject to extensive media scrutiny and a civic lawsuit alleging widespread code violations, unpaid taxes, and contested deeds, and a court has ordered rent to be held in escrow until repairs and compliance are demonstrated. That action directly interrupted on-chain payouts to token holders and exposed how fast on-chain cash flows can be cut off by off-chain failure. Outlier media dev. 2. Liquidity is a promise, not a guarantee. A core selling point is secondary market liquidity. Trade your token anytime. But academic and market research show most real-world asset, RWA tokens exhibit very low trading volumes, long holding periods, and fragmented demand. Without deep, regulated trading venues, tokens are effectively illiquid private assets dressed up in crypto clothing. That means exits are slow and often require steep discounts. Exactly the opposite of the liquid asset pitch. Arxiv SSRN. 3. Blockchain plumbing eats yields even when rent is legally distributable. Getting it into a usable bank account or wallet is costly. Platforms frequently mint tokens and pay dividends on cheap chains, Gnosis, Tezos, Polygon, to reduce their own costs, forcing investors to bridge and swap if they want funds on major exchanges or in fiat. Each bridge or swap carries spreads, slippage and fees. Mainnet gas and withdrawal costs can add unpredictable, non-trivial drag. Real-world fee guides show cross-chain or Ethereum bridge events routinely cost several dollars to tens of dollars, which compounds fast for small periodic distributions. These technical frictions can shave several percentage points, or more, from advertised ROI. Medium cryptonerd.xyz. In short, the 15% yield headline becomes much less attractive once conversion, bridging and gas fees are counted. 4. Regulatory arbitrage shifts risk to investors. Many tokenized offerings rely on cross-border structures or exclude domestic retail buyers specifically to avoid rigorous securities and consumer protections. The SEC and other authorities are clear. Tokenized securities are still securities and must meet disclosure and custody requirements. But until enforcement and global harmonization catch up, issuers can market to jurisdictions with weaker oversight, leaving international buyers with limited remedies when things go wrong. This regulatory gap incentivizes structures that maximize capital raising while minimizing transparency. SEC +1. 5. Real examples. Why headlines matter. The Detroit case is not an isolated PR problem. It demonstrates multiple failure points at once. Alleged missing deeds, unpaid municipal obligations, fragmented LLC ownership, poor local property management, and judicial intervention that halted rent collection and evictions for affected properties. Those facts show how quickly investor returns can be interrupted by local enforcement, and how hard it is for a geographically scattered group of token holders to enforce remedies. Outlier media city of Detroit. 6. Why global buyers' local problems is a structural issue. Tokenization scales buyer pools without scaling local governance. That creates 3 systemic weaknesses. Enforcement asymmetry. Token holders are worldwide and diffuse. Landlords, codes and courts are local and concentrated. Enforcing obligations across borders is slow and expensive. Incentive misalignment. Issuers earn fees from token sales and distributions. They have weak day-to-day incentives to fund long-term maintenance if the business model pivots to continuously issuing new tokens. Concentration risk. Platforms buying entire neighborhoods can create single-point failures. If the operator fails, many token holders are hurt simultaneously. 7. What we, as investors, must demand. A minimum checklist. If we are to take real estate tokens seriously, platforms must meet hard, verifiable standards before we consider investing. Verified title and deed records published and verifiable in the county registry, not just claimed in marketing. Clear SPV contracts showing where legal ownership lies and investor remedies. Independent audits of property management, rent collection, and tax payment histories. Escrowed repair and insurance reserves, mandatory for older housing stock. Transparent net yield breakdowns that include platform fees, expected maintenance, bridge, conversion costs, and realistic vacancy assumptions. Regulatory disclosure. Copies of legal opinions on security status and why specific jurisdictions are excluded from purchases. Liquidity venue assurance. Evidence of regulated secondary markets or realistic exit paths, not just token listing PR. Absent these, tokenized properties are speculative bookkeeping entries with operational risk, not real income assets. 8. Conclusion. Don't confuse digital wrappers with solved problems. Real estate tokenization is a powerful technical idea that can broaden access and automate payouts. But technology does not automatically solve legal title, municipal code enforcement, tenant law, insurance markets, or convertibility costs. When we buy a token, we are buying both an on-chain instrument and exposure to an off-chain set of human systems. Too many platforms sell the token while outsourcing the hardest work: reliable local property management, compliance, and full transparency. If we want tokenized real estate to be anything more than a hype cycle, the industry must stop prioritizing rapid issuance and marketing narratives and start proving, with public records, audited operations, and regulated trading venues, that tokens represent enforceable, well-managed ownership. Until then, global investors, local problems, will remain not a slogan but a warning. Attractive headlines, fragile realities, and a very real risk that investor capital is being sold a promise, not a property.